there's like a perfect storm that's brewing out there, and I think it's probably going to hit our system, if not in the fourth quarter this year, the fourth calendar quarter, certainly in 2019.
Are you tired of overpaying for your gold, silver, and platinum bullion coins and bars? Then visit sdbullion.com today. SD Bullion was recently named the 177th fastest growing company in the United States by Inc. magazine. This is because they offer the absolute lowest prices in the industry and follow up with over-the-top customer service. So what are you waiting for? Go to sdbullion.com today and join more than 60,000 happy investors that save money on every precious metals purchase they make.
Hey everyone, this is Elijah Johnson with SilverDoctors.com, and back with us today is Dave Kranzler from Investment Research Dynamics. Dave, thank you so much for joining us today.
Thanks for having me on again, Elijah. I always like chatting with you.
Definitely. And today we had the FOMC meeting, and they released their decision about interest rates. Now, it was pretty much just as expected. What we expected was a 0.25% rate hike. Some were thinking maybe 0.5%. But yeah, we just got 0.25%. And the one really interesting thing about this is that the Fed is saying they're no longer using the word accommodative they never didn't use that word in their statement. So according to them now, this 2 to 2.25% interest rate that they're targeting is no longer accommodative. What is your perspective on that?
Was there a FOMC meeting today? Did they announce anything? Was there anything meaningful that came out of the talking heads from the FOMC committee? I took some notes just so I have to refer to my note sheet. It's all political grandstanding and propaganda. The Fed funds rate, 2 to 2.25%. I guess the FOMC said the Fed's inflation target for 2018 to 2021 is 2%. I don't think there's anyone in their right mind who really, well, there are people out there who I guess really believe that the inflation rate is 2%, but it's one of those things where they're not trying to measure inflation. They're trying to create a number that justifies their low interest rates, because if they jacked up interest rates to what would be considered normalized, which would be at least equal to the rate of true inflation, it would crash the economy. They also said that the Fed sees the unemployment rate falling to 3.5% next year. I guess it's supposedly it's 3.7% this year. We'll tell that to the 102 million people, 6 million of which are officially unemployed, and 96 million of which are no longer counted as part of the working age population. So they're not even counted as part of the labor force. I mean, I can create statistics using a data sample, as long as I can cherry pick all the data that goes into the data sample. So, perhaps some of those 96 million people don't want to find a job, and they don't need to. But I can guarantee you, if you took away the ability to get student loans, and you took away, or you made Social Security, disability, and welfare harder to get, that you'd have at least 50 to 75% of those people out looking for jobs that they wouldn't be able to find. And, to say that the labor market is tight is an absolute joke as well. Because if the labor market was tight and there was a strong demand for jobs, we would see wages rising very quickly. And wages on a inflation adjusted basis are basically flat to falling. So, the agenda of the Fed here is to hold up the system for as long as possible, and the only way they can do that is to keep interest rates as low as possible. I mean, they're nudging them up a quarter of a point at a time, 25 basis points, in order to make it look like they're doing something, but they're not really doing anything. I mean, if you use, let's just look at John Williams, and he measures inflation the way that the CPI was calculated, like I think in 1980 or 1990. They've rejiggered it. They rejigger it every year, and that started with the Arthur Burns Fed. People can look that up if they don't believe me. Started with the Arthur Burns Fed when the U.S. went off the gold standard. And they rejigger the way the CPI is calculated in order to reduce the amount of inflation that the CPI reflects. So anyway, getting back to John Williams, and I subscribe to his publication, but I can't remember. I usually skim through it. I think the way he sees inflation more at like something like 6%. And if we went and said, okay, normalized interest rates historically over a long period of time, short-term rates are set to exceed the inflation rate by about 3%. And that's when you have a healthy economy. So if you took Williams' number and you added 3% to that, it says Fed funds should be at 9%. Well, guess what? I went back and I looked at the last time that the unemployment rate was measured to be 3.7%. That was October 1969. Guess where the Fed funds rate was set? 9%. All right. Now, what's the difference between now and 1969? Formally, officially, the world was still on the gold standard. Nixon hadn't closed the gold window yet. That didn't happen until 1971. So if they want to normalize the Fed funds rate, they got to take it up to at least 6%. And technically, it really should be more like at 9% if this economy is doing what they're saying it's doing. And it's not. So anyway, in a nutshell, that's what I think about what Jerome Powell has to say. It's what I have to think about what everyone who reports and regurgitates what the Fed has to say. That's what I think about their analysis. It's useless.
No, to your point about the alternative ways to measure inflation, if you use, I'm looking at the website now, shadowstats.com, John Williams' website. If you use the 1980 inflation, essentially how they calculated it in 1980, you get about a little over 10%. You get 6% if it's 1990 based. So yeah, to your point.
There you go.
Definitely there's a really good argument to be made that, the current way of measuring inflation it shows, just above 2% or so, maybe 2.5%, 3% is like the official number. That might be an underestimate. And how does that kind of skew everything else?
An underestimate. Maybe the inflation rate is 2% if all you do is buy computers, because technology-based consumer products or TVs go down in price every year, right? So, just look at oil alone. Oil's up 45% in the last year. And I think it's actually in less time than that. I looked at it the other day, maybe 45% since maybe in the last 9 months. Whatever, it doesn't matter. It's up 45% from where it recently hit a bottom. It costs me about 30% more to fill my gas tank now than it did a year ago. My insurance premium for health and for auto have gone up a lot more than 2%. The cost of medical care is soaring. The cost of a bag of groceries. Right now, roughly the same bag of groceries that I buy, and I buy pretty much the same thing all the time as a bachelor and cook for myself. My food supply is pretty consistent. A bag of groceries is probably 15 to 20% more for me this year than it was last year. And that's with the price of meat has actually gone down a little bit in the last year. So I guess if you live in a cave and you only buy TVs and laptops, then maybe inflation rate's only 2%. But just the statistics and the numbers they throw out there are an absolute joke. So, what does a 2% Fed funds rate mean? We're starting to see the inflation rate really start to torque up. As you said, I didn't realize that the way he measured it in 1980 is inflation is measured as 10%. But I have a feeling, to be sure, we're starting to see in some areas of the labor market, wages are going higher for areas where there's that require high technical skills, and a high degree of education. Wages are starting to go up in that area. But I think what we're going to end up seeing, and this is with the housing prices starting to fall, I think we're going to start to see the effects of the of the highly accommodative monetary policy that we've had for the last 10 years, including all the money they've printed and all the credit that they've enabled to be created, is going to start really coming through in real inflation.
Now, with regards to the stock market, you recently wrote an article about how, we just recently saw the Dow make a new all-time high just a few days ago, but you're saying the fundamentals for the stock market are actually deteriorating. Can you expand on that?
What I'm talking about is the economic fundamentals that underlie what's supposed to be the price discovery mechanism for the stock market. So I'm talking about the housing market, talking about auto sales, I'm talking about the real unemployment rate, not the phony, let's pretend the 96 million people who don't have jobs, most of which would like one, let's just pretend they don't exist. Or let's give them Sallie Mae loans so they can enroll at the University of Phoenix, and once that event happens, then you get removed from the labor force. The real economy that generates real economic activity, everything that I look at, especially, and I do this every week intensively for writing my short sellers journal. I really drill down deep, and it goes well beyond looking at what's reported in the mainstream financial media or looking at Zero Hedge, because there's places where you can find real data. And there's actually, industries and industry organizations, not the National Association of Realtors, but that have been releasing economic reports that are falling short of Wall Street's expectations at an increasing rate. I mean, so when I say that the fundamentals are deteriorating, I'm talking about everything that drives real economic activity is slowing down. In some cases, it's stalled out and hit a wall.
Now, how does that impact Main Street then?
Well, it's going to affect corporate revenues, corporate profitability, and it's going to affect a lot of people who are going to be affected by the areas that are slowing down. The housing market and the auto market are two very large sectors of the economy. People think technology is the be-all and end-all, and that's what drives things. No, that's not what drives things. Technology may be the catalyst that improves the quality of life for a given cost unit of buying that quality of life. But it's real economic activity, building houses, building cars, industrial production, manufacturing, that type of thing. And there's so many things that feed into both of those industries. I know at one point, and I don't know, I don't think it's true anymore because the service sector is such a large part of the economy now, but at one point, essentially the economy was a three-legged stool. It was housing, autos, and government spending. So as we've seen, not just because of the Trump tax cut, corporate tax revenues are falling off a cliff. And actually, if you look at payroll taxes are flat. If employment was as strong as they say it is, and if wage growth was what they say it is, payroll tax withholdings should be going up. And it's irrespective of the tax cut, because first of all, the tax cut didn't really affect payroll tax withholdings for the middle class. And to the extent that it did, what they're telling us is the growth in employment and the growth of wages should have more than offset the tax cut in terms of payroll tax withholdings. I have the data; it's not in front of me, but you can go on. I forget what website it is, but I have it for the first 10 months of the fiscal year, of the government fiscal year. So the second factor that's going to affect is the spending deficit. Already, the government's spending deficit and treasury bond issuance is at $1 trillion run rate. It's not going to show up that way for the entire fiscal year, which ends this month. But starting for fiscal year 2019, which starts October 1st, I will bet anything that the spending deficit is going to be at least $1.5 trillion, and the treasury issuance is going to have to be at least $1.5 trillion to cover that spending deficit. And you're going to see the market itself is going to drive interest rates up higher. And the only way the Fed will be able to combat that is to restart its money printing program and buy treasuries, because I don't really know who's going to buy all that treasury issuance. I mean, certainly Trump's pissing off China to an extent where they just may say, no, we're not interested in treasuries right now. On the other hand, what's your bid for the ones I'm holding? So, there's like a perfect storm that's brewing out there, and I think it's probably going to hit our system, if not in the fourth quarter this year, the fourth calendar quarter, certainly in 2019. And whether or not that torpedoes the stock market or not, I don't know. I mean, we are seeing declining market breadth, and fewer stocks are actually participating in the rally. And today's a good example. I mean, the Dow was up over 100 points after the Fed said, "Hey, man, we're probably going to mellow out on interest rate hikes, even though another one is expected in December." The Dow was up 100, and it actually ended up closing down 106. And I honestly didn't see any comments made by Powell that would have necessarily triggered that. I actually thought that if the Fed came out, the conventional thinking would be, oh, well, if the Fed starts to ease up on its tightening, its alleged tightening, the stock market should go higher. And I actually said several months ago that if the Fed starts to ease up on its move toward tightening, that we may actually see the stock market sell off. And today's just one data point, but that's what we saw today.
So the last time we had you on, we talked about the Commitment of Traders report. So I wanted to discuss a bit about precious metals. You said the Commitment of Traders report was showing that commercials were taking net long positions in both gold and silver, and that, there must be some reason for this. So this was very bullish for precious metals. Now, can you give us an update on this? What is the COT report showing now, and is it still bullish?
Yeah, the COT report is extremely bullish. It's as of the latest report, and again, I looked at the numbers when they came out last Friday, and so this is kind of off the top of my head. It looks like, at least through a week ago Tuesday, that both the banks and the just general commercial segment somewhat reduced its net long position in both gold and silver, and the speculative, primarily the hedge funds, somewhat reduced their net short position in gold and I want to call it paper gold and silver, just to make sure we differentiate it from physical gold and silver. So, I mean, in terms of the way the Commitment of Traders report is tilted, it didn't really change that much. And I mean, the key with the Commitment of Traders report, again, assuming that the numbers are bona fide, it essentially is telling us that for whatever reason, the banks generally are, think that the price of gold and silver are going to go higher. I did notice Goldman Sachs came out with a forecast for higher gold, as did Bank of America. And historically, the hedge funds, when their positioning is at an extreme, whether it's long or short, they're always wrong, always. Now, what the Commitment of Trader structure or setup doesn't tell us is the timing on when a move could come. So I know India's demand for physical gold the last few weeks has been kind of somewhat derailed because there's the emerging market flu has hit India pretty hard over the last few weeks, and it's the value of the rupee has fallen quite a bit, and it makes it more expensive for Indians to buy gold, and so their importation of gold has been somewhat curtailed, even though this is we're going into their best seasonal buying period. Now, I mean, at some point, that situation will soften up, or it might start to reverse. We'll see a bounce in the rupee, and when there's ever a delay in India's importing of gold, there's always a massive snapback that either makes up for it or more than makes up for it. So that's going to happen at some point in the next 4 to 8 weeks, I would think. China's been kind of just from the data that comes off of the Shanghai Gold Exchange. China's also been a little bit slower than usual, and I think part of it has to do with, the trade war escalation. But at some point over the next 3 months, we're going to see a huge wave of demand coming from China and India. So, again, I think, and especially if especially if the Fed is softening up on its stance toward hiking interest rates, and as it becomes obvious that this trade war is just crushing, the U.S. spending deficit, and it becomes more obvious by the day that the U.S. has to issue more and more treasuries, it's going to ignite a fire under gold and silver. So it's just a question of time.
All right. Well, that'll be very exciting if that does play out. Well, Dave Kranzler, thank you so much for your time today. People can go to investmentresearchdynamics.com. And once again, thank you so much for your time.
Thanks again for having me, Elijah.
All right. Thank you so much.